Hello everyone, my name is Toon, the Chief Investment Officer of Asia Pacific Equities at RHB Asset Management. Welcome to another episode of our podcast. In this podcast, we will discuss a few key current drivers of the Chinese stock market. The equity market started 2021 strongly, with the Chinese equity markets, as measured by MSCI China, up 20% by the middle of February. However, in February, we saw a sharp spike in US 10-year bond yield, with the yield increasing from 1% in late January to 1.5% by late February. This sharp rise in bond yields resulted in a general de-risking in the stock markets. This resulted in an 18% retracement in the Chinese stock markets from the highs we saw in February. However, we would note that an increase in bond yields is to be expected in a year where countries all over the world are starting to recover from the pandemic, with the discovery of numerous vaccines and the rollout of national vaccination programs. In addition, as history has shown us, an inverted yield curve has predicted the past 8 recessions. A steeper yield curve, conversely, has typically predicted an economic recovery. Furthermore, it appears that the 10-year bond yield has retraced from the recent highs of 1.74% and has started to trend down to its current level of 1.57%. This has brought about a much needed calm to the equity markets. As the first major economy to control COVID-19, China is now taking the global lead to rein in the pandemic-driven stimulus efforts. However, it is important to note that China is not tightening and withdrawing the stimulus in a drastic manner. Rather, we will view it as a normalization of monetary and fiscal policies from the excesses that we saw during the depths of the pandemic crisis in 2020. We find it useful to analyze the total social financing data, which is indicative of the overall credit cycle of China. We note that the total social financing year-on-year growth in March is 12.3%. This overall credit indicator for China is still growing at a very healthy level, albeit slightly lower than the 13.3% and 13% that we saw in February and January respectively. Such normalization of credit stimulus would be reasonable at this current stage of the economic recovery in China. However, we do believe that the Chinese government would be concerned with an overheating property market, and as such, would be specifically targeting the China property sector. Policymakers will no doubt once again reiterate that housing is for living and not for speculation. As such, we will be cautious on the Chinese property sector, especially in view of the recent strong property sales in China major cities. Our listeners may also recall that Ant Group IPO was suddenly cancelled in November of 2020. Subsequently, its parent Alibaba, the Chinese internet giant, was reportedly subjected to anti-monopoly probe by the Chinese regulators. As a result, we have seen Alibaba share price tumbled 30% from its high. Over the course of the last few weeks, there were two key developments on this front. Firstly, Alibaba was fined a record $2.8 billion for abusing its market position. Secondly, Ant Group will have to revamp its business as required by the Chinese authorities. Specifically, Ant Group will be transformed into a financial holding company, which will be supervised more like a bank. In our view, the fact that there is a fine, albeit a world record-breaking one, does at the end of the day signal that the anti-monopoly probe has reached a conclusion of sorts, at least for now. Alibaba also indicated that they are not aware of any additional ongoing investigations. In the eyes of investors, this is a removal of a major overhang. Even though $2.8 billion is a record-breaking fine, but it is still very manageable by Alibaba standards. To put into context, $2.8 billion is just 4% of Alibaba annual revenue, 12% of its annual operating earnings, and 6% of existing cash. Alibaba also announced that Ant Group has completed the formation of a rectification plan, which includes the setting up of a financial holding company. With a stated framework in place, we believe that investors, like ourselves, can now objectively assess what's the worth of Ant Group, rather than be swayed by rumors and hearsay. In conclusion, we believe that 2021 will be a year of recovery, and China will lead the way in terms of the control of COVID-19 virus and the recovery in GDP growth. However, in light of the valuations of the market now, investors will need to be nimble and pick the right stocks and sectors to successfully navigate 2021. With that, we have come to the end of our podcast. Hope everyone stays safe and healthy in your daily lives and in the market as well. Thank you very much for your time.